Right now, though, let's get a little more reaction to this latest economic data with Henry McVey. He's KKR's balance sheet CIO. And Henry, it's been a while since we've seen you. Thanks for coming in.
It's great to be here.
Let's talk. I know you're just coming back from Asia, and I want to talk about that. But first, let's focus on what's happening here in the United States. What did you think of these numbers? Better than anticipated on many levels.
I think they really justify what we've been saying about KKR and our portfolio companies, right? We typically own 150 to 200 businesses around the world. Really, when you think about the U.S., Rick hit on one huge point. There's a CapEx boom going on, and the big, beautiful bill will accelerate that. But you're really seeing, if you look at the first half of the year, AI CapEx was actually grew more than all the growth in personal consumption, which is a massive thing to digest. Yeah. Second, though, what we saw in the revisions is personal consumption came up. We've been talking about a lower unemployment this cycle. Some of that's demographics. Some of that is a less supply of labor. And so I think that was also echoed in the data. The one thing that's kind of noise is in the first quarter you had a negative GDP. That was because people were pre-buying. And then the second quarter you had a lot of export. So we really focus on the investment and we focus on the personal consumption, which is about 70% of the economy.
Mike Wilson was here earlier this week. And Joe, correct me if I'm wrong. I think he was saying that he thought things kind of bottomed out in April and that the economy has been picking up ever since. That's his view on where things stand. And as a result, he thinks equities will continue to climb. Do you share that view?
He said something about that their long-term case had been a rolling recession that's now over. Yeah. And that we're going to start reaccelerating, but we need rate cuts for the reacceleration to happen.
Yeah. When we grew up, the U.S. consumer levered up and buy, and it would lift the rest of the world. And what we've been in this cycle is kind of this asynchronous recovery where you have a manufacturing recession, but services is doing well. Think about what's been happening in the manufacturing sector. The ISM's been below 50 for 30 out of 32 months, and we haven't had a recession, right? And so there are pockets of the world that are doing well, and there are pockets of the U.S. economy are doing well. So every day you could come in and be bearish or bullish based on the data.
Right.
Our base view, and, you know, I think last time we talked, this is like glass half full. There's a productivity boom going on in the U.S. that is very reminiscent of the 1990s that I think people don't fully appreciate. It allows you to pay higher wages. It allows you to endure the tariff hit to margins, and ultimately it drives revenue growth. And that's really from the COVID hangover, from digitalization and automation. And now what we're seeing in our companies is some acceleration in AI productivity.
Does it also mean that the jobs market could suffer because you're going to pay your existing employees more to squeeze a little more productivity out of them and not necessarily take on new employees?
I think there's, let's separate the macro from the micro. At the macro level, the government data is going to look poor because of two things. One is the government jobs have been a huge contributor to jobs, and that's probably going negative. And then second is we've had a huge narrow focus on just healthcare and education. Outside of that, most sectors are actually flat to negative. And so I think there's going to be a lot of volatility just based on those two sectors. What we see, and is kind of corroborated by what Rick said and what you see in the ADP report, is our businesses are doing fine. Maybe there's a little bit slower hiring, but there's no firing boom going on the way that you've seen that kind of predated past recessions. And that's why I get back to this view. I think the Fed needs to, they've shifted their mandate from inflation to employment. I think if you think about it, if President Trump hadn't slowed the supply of labor, the unemployment rate would be closer to 5%. And the Fed would be
from the immigration.
Yes.
Yeah.
Yes.
Shutting down.
Right. And so there are a lot of statistical quirks that are going on right now. What I would say from our perch is things are doing fine. They're a little bit slower. You have to appreciate that most CEOs and CFOs are trying to figure out, one, tariffs, and then two is the benefits of the tax bill. Our base view at KKR is that we will continue to go through, and the economy will be 1.5% to 2%, maybe a little bit of upside based on the revision today, but I think we'll be fine. I think
meaning that the Fed doesn't need to cut rates?
No, I think the Fed does. The housing market is very weak right now. You were just reporting on that. That is true. About 21% of states actually have negative HPA, home price appreciation right now. The low-income consumers feeling the impact of higher inflation. And ultimately, there are levered entities in the community that borrowed when rates were super low, and they're feeling some of that pinch. So we have 2 more cuts this year, and we have 3 next year.
Your view, though, from the KKR portfolio perspective, with the 150 to 200 businesses that you're managing, is that businesses are continuing to spend, CapEx is continuing to go up, consumers are doing okay, and so maybe the market looks pretty pretty safe at these levels.
Yeah, and it's starting to broaden out. I mean, we could have some pullback here because we've had a pretty big run, as you guys had mentioned earlier, but ultimately you're seeing some broadening out. Biotech's performing better. Some of the small caps are performing better. I just got back from Asia. Korea's up 60% year to date. China's up, 35%. Japan's up another. Last time we were here, we talked about Japan. Nobody owns these markets, and the dollar is weakening. They're cheap. 70% of Korea trades less than price. 70% of the market trades at less than book value. And Japan, 3 years later, after we've been highlighting this, it's still 40% of that market trades at less than book value. And from a private equity standpoint, there's huge opportunity where these big companies are shedding unprofitable or non-strategic subsidiaries. And so activism is going to Japan. Corporate reform has come to Korea. And even the Chinese, you're starting to see some things in that market where the market is performing better. That's one half of the Asia story. The second
opportunities for private equity, not necessarily for investors investing in those markets.
But we have this notion of kind of capital heavy to capital light. When people are improving their corporate footprint, the stock goes up. I mean, we bought the receivables from Harley Davidson. The stock went up 20% that day. That technology and that structuring is going to Asia, and it's also going to Europe. And that's where you're seeing some pretty big opportunity sets, both for the private markets, but also the public markets.
I hear you on the dollar's weakness and making part of that argument, but what about the tariffs that those countries are going to have to face with exporting things to the United States?
I mean, look, if you take a country like China, it's redirected towards Southeast Asia, towards Africa and other markets. What's happening, though, bigger picture, is that you're getting kind of this tripolar world where Canada, the U.S., and Mexico are trading more, Europe's trading more, and then Asia is starting to trade more with itself. If you look at the data, about 48 to 50% of trade in Asia is with itself. We think that's going to go to 70%, which would be more akin to Europe in the Americas. And that's why you've seen a huge uplift in what's going on around logistics, infrastructure. That's a booming business for us. And you see this when you talk to the executives there. They want to have their supply chains. They're uncertain about what the macro and the geopolitical environment is. So they're shortening their supply chains and they're trading more with themselves. And the second big theme is that consumption upgrade within Asia, Vietnam, India, some of the other big markets where we invest. They're starting to see their GDP per capita going up, and they're benefiting from traded goods and services in that market. Europe didn't really ever have as much cross-border services, but we're seeing that in Asia grow faster.
What, if anything, worries you?
Look, the two things, the AI spending at the rate that it's growing is a huge positive influence on the economy. If we were to see return on capital in that sector fall off faster, that's a real cyclical boom that would affect GDP. The second thing is our base view at KKR is that unemployment's not going to spike to 5.5%. If you saw a real change in the labor market that really altered the employment landscape, that would be a shock to the system. Otherwise, I think, and then the final one is more structural. It's hard to measure on a day-to-day basis, but folks got to watch this productivity boom, right? And think about it. When we restate the data, right, the BLS is told us that they're going to take jobs down by 911,000. What's going to happen to the data? The productivity numbers are going to go through the roof. And it's going to further confirm our thesis. At the same time, it's going to tell you that Americans have a lower savings rate, and that's going to make people more nervous about low-income credit. And hence, one of our views that the Fed needs to continue to ease to support that part of the market.
Okay.